sessions since I think May last year on a range of topics. It's really nice to see some new faces today, and I think this is a very different topic for us, but something that people are obviously really interested in, which is great. If you've missed any of the other Irish 30 sessions, we do have a YouTube channel where you can check those out, and there's lots of really useful information on all aspects of well-being. And tonight we're focusing on financial well-being. But before we get started, I'd like to begin by acknowledging the Guijo people, who are the traditional custodians of the land that I'm joining from this evening. And I also acknowledge the traditional custodians of the various lands that you're joining us from tonight. So just while we settle in, I'm going to hand over to Kevin Clancy, who is our resident mindfulness expert, and he's going to do a quick little arrival exercise just to help us settle into the session.
Thanks, Roisin, and good evening, everyone. Lovely, as Roisin said, to see some new faces on these calls. I'm just going to do a very brief arrival exercise, just so we can all land into this session and maybe put whatever we've been carrying over from our days or from our day behind us. So if everyone wants to get kind of nice and comfortable in their seat, maybe straight back, 2 feet on the floor, if it feels right for you, if you want to close your eyes or just gently lower your gaze and begin to turn your attention inwards. And bringing attention to the breath. Just noticing the breath as it moves in and out of the body. And if it feels right for you, bringing your attention to some of the sensations associated with breathing. Maybe noticing slight change in temperature as the air enters through the nostrils. Or perhaps noticing the gentle rise and fall of the belly as it moves in rhythm with the breath. And in your own time, just opening the eyes and arriving into this session. Thank you, everyone. I think I'm passing to you, Una, now, is it?
Yes, thanks, Kevin. That was lovely. Thank you very much.
You're very welcome.
Thank you. So good evening, everyone. Thank you so much for joining us. We have with us tonight Ciaran Davis. Ciaran is a highly experienced financial planner and advisor. He is originally from County Wicklow. He's been over in Australia for about 8 years now, and he's joining us tonight just to give a bit of information in regards to budgeting, saving, and a little bit of information about buying a home. So Ciaran, thank you so much. We really appreciate you being with us tonight, and I'll hand it over to yourself. So thank you. I'm just going to share my screen. I'll get the presentation up. Okay.
Lovely. Thanks, Una. So yeah, my name is Ciaran Davis. I've been a planner for about 22 years. Moved over to Australia in 2013 and started a business over here. So what I guess I'm trying to do today is just impart some of the bits and pieces of knowledge that I've gained over the years, what's been useful to a lot of my clients and what I've seen work with a lot of people over the years. So I'd like to just point out that the information that I'm passing on today is general in nature. There's nothing, I mean, I don't know anybody's situation, so I can't give you individual advice. If you do need individual advice, please do go and see a financial planner and get appropriate advice to your circumstances. All right, so budgeting and money management. So I'm a firm believer, I guess, that everybody should be in control of their finances. After doing this just job for about 20 plus years, you kind of get a feeling about how people work their money and how involved they are. I mean, a lot of people on a day-to-day basis who don't even look at their payslip, don't look at the money that pops into their bank, and they just expect to, that there's always money there to pay their bills. So if I can help people with that and get them to understand their income and their outgoings on a very basic level, I think I've helped a lot of people. So in terms of budgeting understanding, it's really important that you at least look at your pay slips. I might be telling a lot of people here how to suck eggs, but if you can look at your pay slips, look at the net income, look at the gross income, to make sure that you're being, you're accumulating your sick leave and annual leave, and that the employer's paying your super. That'll be a very, very good start. It's always easier to, I suppose, track your income than your expenses, but please keep your pay slips. Look at what's on them, and then compare to what's going into the bank. I like people to track their spending. So everybody looks at this a bit different. I tend to be quite detailed in how people track their spending. I use a budget for all of my clients, and it'd be amazing how many people don't actually get to see or understand what's coming out of their bank account on a regular basis. It can be quite tricky. So if you've got, annual expenses and monthly expenses and quarterly expenses, I find it's best that you annualize everything, understand how much you need to put away on a regular pay cycle, whether that's weekly, fortnightly, or monthly, and then build up so that you have money for that, annual rego, the annual holiday, and you're not left short when you need money. I also really strongly advocate that people build up a rainy day money, that people understand that, things are not going to always be rosy. I noticed in Australia, everybody thinks she'll be all right, mate. And unfortunately, coming from Ireland and we know that it's not. But it's always important that you save for a rainy day. One of the things we use, as I said, is a budget planner. The budget planner is a great way to segment everybody's expenditure. You can find a whole range of budget planners on the internet, but the one we've put here is Money Smart. Money Smart gives people lots of resources that they can use on a day-to-day basis, and it breaks it up into your short-term expenses, your medium expenses, and your annual expenses. So things like your rent that you pay on a regular basis are your fixed expenses. Things like your rego that comes out annually, and then your quarterly electricity. So once you get to understand what these expenses are, you can then put money aside in whatever fashion you want to do. And we'll talk a little bit about this, so that you're not caught on the hop, I guess, when you get a big bill. I like to put away, if I'm going to have a holiday every year, I like to put away a little bit of money every month for that. I like to put away money for the car breaking down, money for any savings that I might want for, home purchase and things like that. But it's important that you understand, once you do your income and expenses, and you have a dedicated amount that is there to meet your annual expenses, then you'll finally know what your actual disposable income is that you can save and build up for the longer term. So you can see your short, medium, and long-term goals. I'm a big believer in setting goals for people individually, so that and being held to account to those goals, so that people can track how they're going towards their objectives. Everybody's objectives are different. Everybody wants to live a different life, and that's great. But unless you put down and write down your goals, it's kind of highly unlikely that you're going to achieve all of them. So the first one for me is building up that emergency fund. Use a savings account. My preference, if you have a mortgage, is that you use an offset or a redraw account, and I'll go through those in a little bit more detail later on. But then if you can commit and save on a regular basis, that's going to help you get into the habit, because savings and investing, it is a habit. And if you're not used to putting money away, it can be very difficult in the beginning to do that and break the habit of a lifetime. From personal experience, when I was over here in the 90s, savings was the last thing on my mind. I was very quick to get paid on the Friday, and Monday morning, after a very entertaining weekend, you'd have to go back to work. But if you can build up that savings, that spare income, that emergency fund, it just takes the pressure away from you when things are not so good.
Ciaran?
Yes.
Would you ever suggest like maybe setting up a direct debit for savings so that it's just going straight out of your account? That's a great question, Una. And I kind of use the phrase pay yourself first. So in that, if you want to save, so you've worked out your expenses and you've worked out your disposable income, and say you've got, I don't know, $500 a week to spare, putting that away or a portion of that away every week will help you help you achieve that goal. So yes, I would nearly, if I was very confident in my numbers, I would nearly put away all of that or a portion of that into a savings account or into an offset account. So you'd actually calculate your disposable income before you would work out how much you were going to save? Yeah, it's better off working out exactly what your expenses are and how much fat you want to leave in the system, for a better word. Okay. Otherwise, you could overexpose yourself, and you could, instead of having that $500 a month or a week and putting that away, you might end up putting away $700 a week. Okay. And then you're leaving yourself short. Yeah. So I would always go through that budget and finding out what my disposable income is first. Couple that with my my goals and my objectives, short, medium, long term, and then put the money away. Okay. So I've put in some information here on different savings accounts, and you and I, Una, had a brief chat about the returns on savings accounts compared to years ago. So unfortunately, it's not rosy. It's pretty dire when it comes to the returns you get. So that you have high interest rate accounts, you have bonus accounts, term deposits. None of them are very, very exciting when it comes to the return. But it does depend on whether or not you have where you are in the life cycle. If you're saving for a mortgage or a home, and you're hoping to have a mortgage in the next 6 months to 3 years, it's going to be difficult for you to get build up a big deposit without using a savings account. I wouldn't advocate ever putting money in the stock market for less than 2 years, because it's quite risky. So if you can, unfortunately, the best rates are 3% on a high interest rate, but you have to be between 18 and 29 at the moment. And it's like 1.45% for just an introductory interest rate. So it's not very exciting at the moment, unfortunately. Longer term, you can, if you're lucky, get a better return.
Remember, interest is taxable, but you'll have to put that into your tax return as long as the benefit of an offset account is not taxable. So that's another positive that we can talk about later. In
Ciaran,
terms
just
of,
a question just
yeah.
on would you advocate having different accounts for different things, like, you know, particular things
Yeah.
for, you know, you said saving for a holiday, or, you know, putting money in for a mortgage or an emergency fund or whatever?
Yep. I think it's a really good question, Kevin. Again, it's down to the individual and how well they are able to manage their money. So if you're pretty diligent and you're pretty motivated and you understand where you are, you may want to just have it in one account and try and get the best interest rate. But if you're saving for the first time and you're not very disciplined in that, I think breaking up your goals and breaking up the accounts is probably a good idea. So you might have a savings account for a car, you might have a separate one for a holiday, you might have a separate one for emergency funds. So it really is dependent on how you as an individual are like with money. Yeah. Again, bringing it back to people who have got mortgages, it's feasible that you could have a mortgage and have 5, 6, even 10 different offset accounts. And the beauty about that is you can have, you know, I will put myself in that class of person where I have a car account, I have a holiday account, and I put money in there every week, and I'm paying down my mortgage a little bit quicker by doing it that way, as opposed to opening up a savings account and you know, getting a very minimal return. I'm very happy to go through offset accounts later on because I'm aware some people don't really understand what they are. But if I come back to the goals and we look at our short, medium and long-term goals, I generally say short-term goals you're looking at 2 years, medium term is about 3 to 5, and long-term is 5+. It does, I guess when it comes to goals, people need to sit down and need to map out what they want and when they want it. It's always good to be, I think, to use SMART goals. So specific, measurable, attainable, relevant, and time-based, so that you're giving yourself a good start when it comes to working out what those goals are and how much you need, when do you want it, and, you know, even if it's actually relevant, and are you going to put the hard yards in to put, you know, because when you start saving, you're going to put yourself in a position where you won't have as much money as you had before, and sometimes that can be short-term pain for long-term gain. You know, not using myself as an example, but if I want to go out and spend $200, you know, going out on the town, and I'm used to doing that, and I suddenly decide I'm going to stick it into a savings account, it can get very tempting to spend that money because it's not an achievable, or my goal's not strong enough. So sit down, have a think about it, have a think about how much you really want to do it, and how much, you know, you look at your disposable income and how much is affordable, and not to put yourself under too much pressure if you haven't worked it out properly. Money is very behavioral, and I think, Kevin, if you're used to, you know, mindfulness, you'll understand that the way your brain processes this information is different for everybody. And, you know, just to say I want to save money, you know, is a lot easier than actually sitting down and doing it. Any more questions on that, Kevin?
No, that's all good, Ciaran, thanks.
Cool. So actually, funny enough, there we are at compartmentalizing savings. So a bit of a case study. I've worked out my goals. I've worked out my timeframes. I'm thinking that, you know, I want about 5,200 for a car in 2 years' time. I've got expenses, annual expenses that we worked out, insurance, rego, etc. I need about $6,000 over the year for that. I've got a holiday that I want to do, and I've got education costs for school. So I've worked out what those goals are. I've worked out the time frame and how much it's going to cost, and then I open up different accounts. And I generally find if you name that account and you make it personal, you know, you say, okay, holiday account, you know, and think about the holiday and think about the place where you want to go. You might want to say Fiji, you might want to say Ireland. Put it down and make it real and personal to you. That way you're likely to, even when times are tough and you go, oh gosh, I wish I wasn't saving so much money, it's causing me a bit of grief. You remember why you've done it. And over time, the first step is always the hardest. And over time, it will get easier, and you will find yourself in 6 months and years time going, yeah, I'm on track. I'm feeling a lot more safe and secure where I am now compared to this time last year. So review it. Don't get too hard on yourself. You know, in this example, we're looking at saving around about $14,500 a year, but it could be as little as, you know, 1,200 bucks, $5,000 a year. The main thing is that you put the first step forward and you make a start. Put a little bit in here now about credit rating, because if we're thinking about buying a property at some point in the future, and you know, we all know Australians and love property, and us Irish love property as well, but the credit rating, particularly for, you know, us coming into Australia, is really important, because we wouldn't have the same track record as somebody who was born here. So there's a few little nuances here that most people wouldn't be aware of. And one is this whole credit rating. And credit rating can be impacted by lots of different, you know, day-to-day activities that we would do and wouldn't be aware of. You know, the score generally is rated on, you know, how much you want to borrow, how many credit applications you've made, and of course, if you've made your repayments on time on any credit that you've already got. So I see lots of people who forget to pay their mobile bill, and that actually impacts on their credit rating. People who don't pay their rates, people who don't, you know, who are not aware of every application that you make can have a detrimental effect to your credit score. So credit score is like an individual score allotted to your name. If you change your house every 6 months, or you change your address every 6 months, you miss your credit card payment, it will impact on your credit score. And then if you're going to go for your first mortgage, the lender will want to know why you didn't make that payment. And then you might find yourself having to jump through extra hoops because you haven't ran your financial affairs as well as you could have done. This doesn't mean it's the end of the world. You can always bring it back on track. And there's lots of different ways to do that. I mean, whether it be, you know, building money up in the savings account, showing that you've got a track record of saving, making sure your bills, as I said, are paid on time, all adds to this credit rating. You know, not jumping from house to house or apartment to apartment, and staying maybe in a job a little bit longer can all help with that as well. It's really, really important though to have an idea of what your credit rating is, and you can do a search. You can go to Experian or Equifax and get an idea. And then if you're going to a broker, he'll give you a bit of an indication of how you stack up when it comes to your first loan.
Do the banks work with you at all on your credit rating and try and assist you in building that back up, or do they just sort of take the score and don't liaise with you after that point?
Yeah, it's a good question, Una. I don't know any bank who works with any client really to get into a better position. Most banks will look at your snapshot at that point, but they're, you know, those guys are in it to make a profit, and you know, I would suggest you're better off going to a broker or a planner and trying to get somebody who kind of aligns with your way of thinking and build your portfolio or your profile up that way.
Okay.
I put in a little bit here about it's possible to have to get declined for credit due to low credit score, and that just basically means you've been in the country 6 months, and they don't have a track record. They don't have enough information on your background to find out if you're a good credit risk. So again, it's very simple to to build that up, put yourself in the best position possible, save. Try not to jump around addresses too much. Try not to jump around jobs too much. And you'd be surprised how quick your credit rating can build up by having a good track record.
Okay.
Ciaran, just on that, obviously with COVID last year, it would have really impacted people's jobs and financial positions, and people maybe accessing super early and all those things. Would the banks be likely to take that into consideration, or just kind of?
Yeah, it's a really, really good question as well, Roisin. So we did see instances where banks wouldn't take an application from someone in the airline industry, for example, or in the tourist industry. Now, whether or not that's probably legal or not is another question, but it does depend on if you've been making your payments. They will give you leniency if you haven't been making payments, if you had to take breaks because of that. I think it would be very wrong to assess somebody who's gone through COVID and had to take a 6 months holiday. But there are, it's a consideration that people should be aware of. Most of those, I suppose, repayment holidays are coming to an end, and it will be in everyone's interest if they could start making those payments back up again. So just be aware, it's not as easy. I mean, it's pretty easy to get money in Australia in comparison to other countries, but it is and will probably get a little bit harder as the months go by.
Yeah, thanks for that.
All right, so home ownership. So I'm working on the assumption that most people, coming to Australia will want to buy their own property for that security factor, and assuming that you're not on a working holiday visa, because we're all citizens or permanent residents. It is possible to get a loan on a working holiday visa, but we wouldn't generally recommend it. And there's lots and lots of help for first-time buyers in Australia, even more so now than there was maybe 2 or 3 years ago. It's not always feasible to get 20%. It's usually a nice to have if you can have a 20% mortgage or 20% deposit on your mortgage, and you will probably get the best rates if you can. But most people coming to the market for the first time would find it difficult in this current environment, with house prices going up, average property price being around about, particularly where I am, 800,000 for a 3-bed in Sutherland. So trying to get 20% can be a big ask, but if you can, you will get the best rates. If you can't get 20%, you are generally looking at mortgage lenders insurance, which is an insurance we as consumers pay to the bank for their benefit in case you don't pay the loan back. We do have something similar in Ireland. And again, it's for the same reason. You don't pay the loan back. These guys get their money, and we've paid a chunk of cash to protect them. Lenders also like to see. Sorry.
Calculated, Ciaran.
So it's worked on a formula, which will depend on every percentage above the 80% loan.
Okay.
So it's on a tiered structure. Sometimes it is better to take the lender's insurance, particularly in a scenario where we are now, where house prices are going up and going up quickly, and you're finding that trying to get that extra 20% is getting harder and harder. So if you've got 15%, say, and you go, gosh, I've got to save another $5 or $10 or whatever $1,000 it is, sometimes it's better to go hard and go early than wait that extra 6 months because you might be priced out of the market. So I'm encouraging, if clients are saying, well, I've seen properties, I think I'm there, get your pre-approval in, see what your situation is like. The old saying, sometimes the best time to buy property is yesterday. But they do like to see genuine savings. So regardless of where most people are, the bank would like to see you've made an effort to save, whether that's for 3 months or 6 months. And it's difficult unless you're a first-time buyer. It's difficult to get away from the costs of a mortgage and the costs of a purchase. So things like legal costs, things like stamp duty. Unless you're a first-time buyer, you may not get away with that. Stamp duty is a big one, particularly if you're buying, over the $800,000 mark. But the genuine savings is going to put you in good stead with the bank. Australian banks do like to encourage guarantors for first-time buyers, and it's something different than what you would have seen at home. So guarantor, if you have one, a family member in Australia, can really, really help with that deposit. So it is, in effect, it's the guarantor is putting their property as security on your loan. So you find a property, you have a guarantor, you don't have 20%, the guarantor will be asked to put that 20% security onto their property. But it saves you having to save extra lots of different, deposit to buy that next property or to buy that first-time property. So it's a very good way to go and search and go and speak to a broker, get onto the property ladder a little bit quicker than normal. But of course, the main disadvantage is you need to have somebody or a family member in Australia that's happy to go on as guarantor.
Oh, that's I know at home they wouldn't have that sort of scheme. They're very strict on mortgage applications and having that initial deposit, aren't they?
They are. So, and it's a bit of a commitment from the guarantor because and they have to have the necessary equity available. So generally, it's going to be a mum or a dad. So there's a strong family tie there, and they should really get legal advice on it because it can impact on their own financial affairs. And yeah, it wasn't. I never saw it in Ireland or the UK for that matter.
Mm-hmm.
But it's a great benefit if you can get it.
Mm-hmm.
I guess it's something for those of us who have been here a little bit longer, or that generation who've been here a bit longer, for their family and for their young ones to do, rather than people who are just arriving in Australia.
Mm-hmm. Okay.
So yeah, stamp duty generally. So it is possible to get away with not paying stamp duty if you're lucky enough. If you're a first-time buyer and you can find a property under 650,000, that is for owner-occupiers and residential properties, not for investment properties. And it's tiered up to about $800,000 as well. So it can apply for, new bills, and that can save you quite a bit of money. So, if you're looking at stamp duty can be like $50,000 for $1 million property. If you're buying up to 800,000, you can save a bit of cash that way. I mean, the amounts in Sydney, 650 to 800,000. It's going to be hard to find a house for that. But certainly, you can find an apartment in some parts in Sydney for that, and outside of Sydney. So again, it's the best way would be to go online, do a bit of searching on it, find a good broker, and he or she can talk you through it. The one thing I put in there is that credit status history in Ireland doesn't affect or impact your credit status in Australia, so that's important. So if you weren't particularly brilliant at saving or particularly brilliant, didn't have a great credit score in Ireland, it's not necessarily going to affect your situation over here. First home buyers grant, first home owners grant. So again, another incentive, and all of these are on the New South Wales website, state revenue website, if you want to go and check them out. But it's another incentive for people to get on the property ladder. It's for new builds, and you can be for a turnkey, one that's ready or one that you're going to purchase, I think. So first home super saver scheme. So again, this one's not really well known about, but you can save in your super. And that's, from a concessional tax point of view, pretty useful. And you can save up to about $30,000 in 2 years. It's a bit of an administration one there because you've got to apply to the super company to put the money in and then take money out. But if you do it in the right format, it's a good way of saving on a bit of tax, and it's a good way of accessing money later on. Then there's first home loan deposit scheme. So again, another way to get, if you have a small deposit, to build up or to get onto the first property a bit quicker than normal. So we've got a few different ways, and a few different strategies, and a good broker will help you work out what's best for you. In terms of the maximum borrowing, I put in here that, basic salary multiples are not generally used in Australia. It's usually debt to servicing ratios. So a simple way of explaining that is, for every $1,000 balance or limit you have on your credit card, they're going to reduce your borrowing capacity by about $5,000. So if you have a credit card and you go, great, look, I've got a credit card and there's $10,000 balance or limit on that credit card, doesn't matter whether you have money on it or not, it's just a limit. The bank will reduce your lending, your overall lending capacity by about $50,000. So you do need to get your house in order before you start shopping around. And again, without over egging it, if you can go to a broker, he'll explain this to you, and maybe you might need to bring that credit limit down. I always strongly recommend people review their home loans. So if you have got a mortgage and you've been in the property, and then you bought it 3, 4, 5 years ago, you haven't looked at the mortgage statement, you're not aware of what the interest rate is. Interest rates in Australia, like Ireland, like the UK, pretty much around the world, are at all-time lows now. And generally speaking, if you're paying more than 3%, I'd nearly say 2.5%, you're probably paying a bit too much. So you should go to the bank, or you should go to the broker and try and get that reduced. And you could save thousands of dollars every year by just having a very simple conversation with the broker or your lender. There's no point giving the bank that money when you've worked hard for it. Moving on to redraw and offset. I'm a huge fan, if you do have a mortgage, that you use an offset account if you can, and or a redraw account. And I'll briefly explain what they are. So if you remember what I was saying about savings accounts are paying very little in interest rates, and imagine you've got a mortgage and you're paying 3%. An offset account is just like a savings account, but every dollar you have in there will reduce on your home loan by about 3%. Plus it's non-taxable, so it doesn't go on your tax return. It's easily accessible. You can have your money out at any point. You could have a tax bill in there, and it'll save on your mortgage bill and your mortgage interest. A redraw account is a bit similar, except it's a credit on your home loan as opposed to a credit in a savings account. It does the same job. It reduces the interest that you're paying. So in effect, will shorten the term and save you the interest on that loan over the longer term. So two very flexible and quite unique product features to Australia that will help you overpay your mortgage and get the loan down quicker. I absolutely love these two features, and I think everybody who has a mortgage, and I get a lot of time where people say, no, I don't want an offset account because it's going to cost me $200 a year. I don't want a redraw account, it's going to cost me $100 a year. You will make that money back, tenfold, even by just having your pay go into those accounts or go into the offset account. Lots of information on the internet about it, and I'd strongly advise anybody with a loan to consider both or either of those features. Other considerations, so if money is needed within 2 years, again coming back to what I said a bit earlier, it's interest rates are pretty poor, but if you want money and it's dedicated money for 2 years, or it's I want to buy a car in 2 years, I want to go on holiday for 2 years, unfortunately offset accounts, redraw accounts, savings accounts are really the only option I would suggest, because it's rock solid and guaranteed. But anything over 3 years, we can probably look at other alternatives, and certainly anything over 5+, we could look at investing in the stock market or have a portfolio in the stock market. So don't get too exuberant with your money in the short term. Don't buy Bitcoin. If it's a rainy day account, don't go in for the afterpay and think that you're gonna save a lot of money, because it can be quite volatile. But under 2 to 3 years, I'd leave it in cash. Anything over that, yeah, as long as it's money that you might not get back or get the same amount of money back, you can look at longer term investments. I think we had a question earlier, Una, about how do you find good quality financial advice, and I'd suggest it's just like finding out a new doctor or a dentist. You ask around, ask your family, ask your friends if they've had a good experience. Go and check out their websites. Go and check out ASIC. Find a planner register. The FPA, the associations, the AFA, they all have websites, and find a search for find a planners, which can be rated or can give you good background knowledge on who you're dealing with.
Well, similar to other professions, Ciaran, financial planners and advisors obviously have fees associated with that service. Is it regulated, or is it pretty standard across the industry, or?
So it is regulated. It's one of the most regulated industries in Australia, and dare I say in Ireland and the UK.
Okay.
The fees, however, it's just like a doctor. You go to a private doctor and he's going to charge you whatever he wants within reason. It's the same for a planner, and I mean I would shop around. Personally, I kind of publish my fees, so I'm happy for the fees to stand up against anybody else's, and I think anybody who's a professional should be happy to do that.
Yeah.
So quite a lot of information in a relatively short space of time.
Thank you so much. I know it's hard to cover such detailed information without spending a huge amount of time on it, but yet we want to cover as much as possible. So I really appreciate how you've made it relatively concise. So thank you so much. Look, I'm sure there are people out there who have questions, and Ciaran is very happy to try to answer any of your questions. So does anyone want to ask Ciaran anything?
I will, if that's all right. Hi, Ciaran.
Hey, Connor.
Just with regards to investing in having a share portfolio or whatever, and I know you're talking about 2 years and so on. Is there a low risk option? Are there low risk options out there? Is that facility there, given that the deposit interest rate with banks is really really low? It's negligible almost.
It is. It's pretty much not worth worrying about. Again, it comes down to your what you want that money for and when you want it. You know, so if you were to say to me, like, I really need this money in 2 years' time because I want to do X, I'd be saying to you, well, I don't care how safe you think the share is or the share portfolio is. 2 years is a pretty short time frame, and anything can happen. So my short answer is no. I wouldn't recommend that you go into a share portfolio for 2 years. As much as it grieves me to say, you know, put your money into cash because there is no return. It's just too risky.
Yeah, I guess I'd be, given that, you know, I left Ireland in 2007, just before the whole thing crashed. Consider myself very lucky, and I'd be somewhat risk averse when it comes to investing. Let's say you had a sum of money, 20, 50,000 or whatever, and you weren't concerned that you didn't need it in 2 years or 5 years or whatever, you know.
That's different then, isn't it?
Yeah. So where would you go in terms of looking for low risk investment options at that stage? I'm not interested in Bitcoin or any of this stuff that's going on with GameStop at the minute. That's just too much for me.
Yep. Again, you're looking at, you know, accessibility. Do you need the money? You need to actually have access to it over, you know, that 2, 5, 10-year period, whatever it is.
Yeah.
There's tax considerations, of course. Australia, I guess the best tax effective vehicle in Australia is super.
Yeah.
You know, you're only paying 15%. So if you don't need it until you hit 60 or 65, whatever you want to retire at, super is a good option. If you need access to it at some point, then you're looking at, yes, a share portfolio. Personally, generally recommend people look at a broad spread, so like an exchange traded fund.
Yep.
And then spread that money between you know, Australia and global investments. So there's plenty of products out there that can do that.
And would you recommend self-managed or through a broker? I guess that depends on your level of competency too.
It depends on your level of competence. It depends on your time, how much research you want to do.
Yeah.
So yeah, if you're a first-time investor, you haven't got a lot of time, you haven't got a lot of knowledge, yeah. I'd say, you know, without blowing my own trumpet, go and see a planner.
Yeah. Okay. No, thanks for that.
That's all right. Yeah.
Now, Ciaran, we have received another question. Now, I know we are planning future sessions on this topic, but I'll put the question to you anyway. It's in regards to super. Someone's come in and said they're still with the same super fund as when they arrived 7 years ago.
Yep.
Realised that they lost a lot more than others in 2020. Any advice for them for navigating super?
Okay, so like, there's so many different supers in Australia. So, I mean, there's a lot of different factors to that question. First thing is you get your super statement and you look at it and you look at where you're invested and you look at the fees. There are some companies I wouldn't, you know, recommend people be in, and I'm not going to say it live, but you know, if a company's been in the press recently for the wrong reasons, I'd be questioning why I'm in that super. There's different probably factors to that point. One would be if you've lost more than other people, the first thing I'd be looking at is where is your money invested. So to me, it sounds like that person is in a pretty high or aggressive investment risk. Mm-hmm. Where, you know, 70-90% of their money is in shares, because that's the main reason you're going to have high volatility. So volatility is when you get a lot of good times and then you get a lot of bad times when the market drops. So you're going to have a higher, a larger drop when you've got a bigger portion in shares, if that makes sense. Mm-hmm. So that's where they should be looking at first and saying, okay, maybe I'm in the wrong investment, maybe I'm in the wrong super, compared to where their comfort zone is.
I know super funds differ greatly, and there's industry super funds, and then, you know, they differ that way. What on a very sort of basic level, what should be your increase with the same contributions year to year?
Okay, that's a huge question, Una.
In a very general way.
Okay. All right, so financial markets go up and down daily and go up and down yearly. And the goal, to think about the goal, is to build up as much as you can between now and retirement.
Yeah.
Yeah. So that really depends on your age and depends on where you're invested. So if I was 20 and I knew I'd got 40 plus years to retirement, I wouldn't be looking at my statement at all. I'd be, you know, putting in the most, or the investment that was going to give me the best return every year. I'd look at the fees. I wouldn't worry about the increases or decreases on an annual basis.
Okay.
If I was 60 though, I'd be having a conversation with myself when I was 50 or 55 and plotting out where, you know, how much I want to live on and what's my retirement look like. What amount of risk I'm willing to take with my money. And I'd be having that conversation every year until I hit retirement.
Okay.
So it is totally dependent on your age and how long you've got till you retire.
Okay. And look, I know we're going to have a separate sort of chat on this, so we won't go into much more detail, but I hope to that person who asked the question that has answered you somewhat, and let us know if it hasn't, and we can try and cover it in the next session.
Yeah.
I suppose, just to sort of finish off, you know, it is about financial well-being at the end of the day, and I suppose from your point of view, I mean, what are the key things that every sort of person can sort of take away in terms of just even thinking about their finance and being honest about their current situation? What are the sort of the key learnings for that?
Yeah, I think that's it is being honest with yourself, isn't it? It's like, you know, everybody probably has an idea deep down where they stand. And I know before I came a planner and I started my studies and everything like that, it was very easy just to go week to week.
Mm-hmm.
So if I can get people to realize, you know, be honest with themselves and say, you know, I could be better with my money. I could track my income a bit better. I could track my expenses a lot better. And I could put money aside. So if there is, you know, that phone call, COVID aside, you're in a position to be able to get home quick if you need to, or you're building your assets and you're building your wealth and you're in a much stronger position, because, you know, moving to Australia is a big deal. So it's not for the faint-hearted. So if you can be aware and more in control, you're going to be a lot better off than most people.
Okay. Yeah. Okay. Well, it's just one more question has come in, and then we will finish up. Actually, Ciaran, we can probably ask that after this, because it's more to do with individual sessions, sort of with yourself. So we can leave that till after that. But listen, on behalf of the Irish Support Agency, thank you so much. It's been very informative. For anyone who would like the presentation emailed to them, we can certainly arrange that. I'll post the contact details after this. But yeah, we look forward to the next one now, and thanks again for everyone jumping on the call.
Thank you.
Thanks for organising it, and thanks, Ciaran.
You're more than welcome.
All right.
Thanks, Ciaran.
See you later, lads. Cheerio.